European Commission has now proposed that standard OTC derivatives be cleared through a central counterparty. A number of people that I've spoken to in the industry have the attitude that this European central counterparty is now a foregone conclusion. Are there any more barriers to this happening? And once we get the central counterparty, how is this going to change the OTC industry?
Well, in my opinion, I think the barriers to entry of cleared OTC is still being figured out. More and more exchanges are offering more and more products. As those products start to fill the mix, you might find that 90% of the current derivative transactions that are out there might fit into the current structures as they're being designed today, and quite frankly, they're being designed because of that way. But there's still pieces of them that don't fit in, and my feeling is that as the regulations become more and more clear about what's going to be required in order to do true OTC transactions going forward, maybe they'll be more capital intensive. Maybe the exchanges or the regulators will decide that these things can't be done at all. I don't think that's going to happen, but I do think they're going to make it extremely more capital intensive. But the move to central clearing is here. I think more and more exchanges, like I said, are offering products, and 90% of them, or 80 to 90% of them, are probably going to fit into the boxes that are being designed today.
What about the other 10%?
They're going to either have to stay bilateral or come up with another product at a different exchange or on the same exchange. I mean, clearly, as these exchanges issue new products, just like any new product, some of them make it, some of them don't. Which ones will be, the leader in the interest rate area? Which ones will be leader in the credit default swap area? All the exchanges are vying for that market space. So it's going to be an interesting turn of events to see where it ends up and how many exchanges globally are going to have those things offer, and not to mention what happens after that. And what happens after that is more and more clients, as they are global, are going to want to say, well, I need to offset these from one clearing corp to another, and that's going to be a very interesting challenge.
You talk a lot about the need for real-time holistic information for dealing with risk and valuations. So gathering that amount of data in a central place for real-time access is a really big undertaking. What's more important for firms, really working for this, should I say, mythical data center, or should they be dealing with data that's just good enough?
Well, I think we'd have to define what's good enough, and I think the regulator is going to help us define what's good enough. It's going to be what they need, and clearly what they need is a better grasp on exposure, on systemic risk. So how do they get there? In the States, they issued the Dodd-Frank Act, and that's going to tell people what they need to do. And quite frankly, it's just starting to become evident of what's going to have to happen. But the first thing is reporting every single transaction. Now, that's one thing. It's a transaction. So every financial services transaction executed anywhere gets reported into a central database. That's a lot of information that gets stored in the database. It's a lot of information that needs to get gathered and standardized. And if you think about all the different types of transactions around the world, from fixed income to equities to derivatives, to synthetics and over-the-counter derivatives, that's a lot of different variations of sort. So I think that creating a standard for reporting and managing them in certain risk areas, like, all right, this is transactional information. We need to cross-reference accounts. We need to cross-reference security information so that those things are readable. Because you can get something from one application that'll say you bought 100 shares of IBM, but it's got a QSIP attached, and you can go over here and say somebody bought 100 shares of IBM, but it's got a quick code or a ISIN code attached. And if those things don't get matched, you can understand the complications of dealing with that type of data. So yes, you have to deal with what's important, and you can't do everything, but I can see it happening in different areas and being brought together.
Can you give me any examples of where this holistic data set is coming to fruition in different firms?
Well, I think it's always been a goal for firms to try to do that. If you look at the prime services space, that's really offers up their clients the ability to transact in any market that they have offerings in, and give it to them in one consolidated view. But most firms don't have that ability to do that in the back office. So they're using multiple back offices, or they're using multiple applications and bringing it together somewhere, somehow, even if it's just to present it on a statement. But I think as the rules and regulations change, and you need to be able to report to the regulators exactly where you stand right now, not 3 days from now, not a month from now. A perfect example is, capital computations that are due in this, in the United States. Those computations are done monthly, and they're due the 12th business day after the end of the month. Well, with firms disappearing or going out of business in 2 or 3 days, that's clearly not going to be acceptable. You're going to need to be able to do a capital computation, and you do. There are rules that say you have to, but the reporting piece of it is what I was getting at. The reporting is going to change. What it's going to be, I don't know yet. Every day, could they call you up at 2 o'clock and say, I need a report by 3? So how do you prepare for that? And what we're trying to do is as a vendor to the industry is to try and be as open as we can to understanding how we're going to get there. And that's the direction that we're trying to head in.
The big topic in Europe right at the moment is the Mifid review, or Mifid 2, and how it's going to affect not only the equities, but moving into FX and fixed income and possibly over-the-counter derivatives. How does the U.S. view this? Are they monitoring how this is going to affect the derivatives, or are they looking for lessons from Europe, or how is that exchange working?
Well, I think you're going to see everyone learning from each other as different pieces and portions of regulations are put in together. And the regulators are talking to each other, where in the past that didn't really happen, but now they are. And I think all the markets are going to learn from each other as to what works and what doesn't work, and maybe the best method to get there. I don't think anyone's ever going to agree on everything, but I think everyone agrees that there needs to be that transparency in the market, and how do we get there? As far as what the rules are going to bring and how clients are going to be able to present that information back to the regulators, regardless of the type of asset that we're talking about, is the issue that everyone's trying to stumble with. We just talked about it with bringing holistic data together. Well, it's the same thing here. You need a standard, okay, in order to send the transactions to get stored by the regulator's database. Otherwise, you're going to send an FX transaction that doesn't look anything like like a fixed income transaction, and certainly doesn't look anything like an OTC derivative. But if you can create some standards, and the reporting mechanism is standardized, which I think it's going to have to be, then that's how you're going to get there. At least that's how the regulators are going to expect it. They're going to say, this is the way I want you to send it. Whether your system can do it that way or not right now, you're going to need to get there. And that's probably the biggest leap. And I think Mifid's going to come along with the same exact issues.
Excellent. Thank you very much.
Thank you.